In this video, you are going to learn about the things that actually matter in order to get funded and in order to get payouts. These things that actually matter continue to work for me, but also for MMT students that apply the same things. So the things that we are going to dive into is, for example, first of all, implementation. We're also going to dive into psychology. We're going to dive into risk management. The things that people usually don't necessarily talk about because they're not fancy, but they are extremely important. So this is then also episode number 4 and the last episode of the Pips to Payouts series. Now, before we dive into the material in just a second, for the people that have been following the Pips to Payouts series, you might be a little bit confused as to, Arjo, this is already the last episode, what happened? I started making this series and I realized that I've talked about these concepts in the past. I've already shown you how a third candle of a fair value gap works. I was about to make a video on market structure and I just got frustrated with myself because I've already talked about those things. So it felt like I was a little bit forcing it up until that moment. So for me, for myself, and in my opinion, and don't worry, this is not the end of the YouTube right here, but it's time to move on to more impactful stuff. Actual things that will help you to get to the next level. Concepts, I've talked about almost every concept out there already. And don't get me wrong, we will still talk about concepts because they are important. But the nuances of them are important. So for example, how you actually apply them. So just so you know, this is going to be a video where I just talk to you and I'm going to give you the most honest and direct advice that I can give you on the things that actually matter. So unfortunately, this is not a new fancy concept video where I introduce all of a sudden something new. No. And quite frankly, to get started with that as well, if that is what you're looking for, constant new concepts, then you're not going to get very far in trading because concepts are important. And this is where we talk about the first topic, implementation. Concepts are important, yes, but concepts are only important to a certain degree. So what is important for concepts is that they resonate with you. So for example, I have a theory. I don't know if the theory is true. I couldn't really care. I just know the theory that I use resonates with me. Whether support and resistance, whether indicators, whether that makes sense to you, perfect, go for it. If that resonates with you, then there's something there because those concepts that can lead you to the next level. So it's important to understand that the concept should resonate with you, not just because someone introduced it and it's this new fancy thing. Now, when you do find that concept, then you want to start implementing it. Because again, like I mentioned, these concepts are important, yes, but it's even more important how you implement the concepts. So you can make support and resistance work, yes, as long as you implement it correctly. So all the concepts that we essentially use and all the concepts we talk about, they fit into the 5 foundational levels. So let's say you resonate with 2 candle rejection. Then that 2 candle rejection, that concept is going to be your main concept, your foundational concept of the trading plan. And then we're going to use the 5 foundational levels to see how we use 2 candle rejection to get to these 5 foundational levels. So for example, the 5 foundational levels. Number 1 is bias. Bias is the first thing you do when you open a chart is to figure out the direction. Are we going higher? Are we going lower? Now you might think, well, how can 2 candle rejection alone help me in understanding what the bias is? Well, for example, right here, when you have a fair value gap right there, that fair value gap is now getting traded back into, and we create 2 candle rejection from that fair value gap. When the fair value gap is holding based on 2 candle rejection, that can then give you in the short term a certain bias. The same, on the contrary, when we have a swing high right there, 2 candle rejection is not holding from that swing high, so it's failing actually at this moment in time right there, and that gives you a short-term bias of being bullish. Now then the second foundational level, once you have figured out the bias, is the narrative. Now the narrative is very interesting because I need you to understand something. Narrative essentially is understanding how far we can retrace. So the bias part is essentially the analyst part. We are traders, so we can analyze the market really well. Is it going to continue higher, continue lower? But that's not the part that's going to make a profit in a trade ID, if that makes sense. Because with a trade ID, you actually need, for example, take profit. You need a stop loss. And because you need a stop loss and a take profit, you need to somewhat understand how far we can actually retrace before we, for example, continue higher. Now, you might know this as a fair value gap. And what I've introduced over the past few years is a context area. So a context area, what that is a context area is from a fair value gap right there towards the first opposing PDA. Now people started running with this. Everyone started teaching, oh, context areas. And they thought it was the holy grail. Again, context areas, don't get me wrong, right? This is not a bad thing. And they work extremely well. But if you want to take it a little bit of a step further, you don't need a context area for your narrative. Because like we already mentioned, narrative, the only thing, what it really is, what it comes down to, is understanding how far we can retrace before we continue higher. That is what a fair value gap, for example, those context areas, they do that really well. But what if I tell you right here that once we disrespect, for example, this premium array right there, and we now are running the 2-candle rejection high, then this area, until we reach the next resistance area, and so until we reach the next PDA, what we can potentially reject from. And this right here is also a narrative area. So this is very high probability. It's also what we call a no resistance run. It's also an area of opportunity, what we call in the MMT. But what is important to understand right there is that at that moment in time, there is no reason to create a retracement. So usually retracements, they are caused because you have opposing PDAs, if that makes sense. So for example, right here, we create this rejection because we have this opposing PDA that's swing high. Now, once we overtake that swing high right there, at this moment in time, this gray box right there is no other PDA that we can create a rejection from. The next first one is going to be this swing high right there, where we can potentially create a rejection. So that means this area is where we will run fast. In other words, where we won't see a retracement anymore before we continue higher. And that is what the narrative area is about. So that way you can also determine through 2-candle rejection the narrative area. Then foundational level number 3, which is the context area, which is very similar to your narrative area as well. In a scenario for 2-candle rejection right here, the context area would essentially be the same thing. So it's where we move from one PDA towards the next PDA, which, for example, the usual one that a lot of people use is the fair value gap right there until the first opposing PDA, which in this case was that previous candle high. In this case, it's from that previous candle high. Once we run it, disrespect it right there, the next PDA right there is this swing high right there. So this gray area is also then a context area. And a context area is quite important because the reason why a context area is important, because that tells you essentially where you look to get involved. So where you can start looking for an entry. Now, the reason why I'm still talking about technical analysis, the reason why implementation right here is quite important to understand is because at first you need to have some guidelines, some objective guidelines. Again, we can only get into psychology, for example, a little bit later on in this video, if we first have somewhat of an edge, right? We can't just blame our psychology and keep blaming our psychology and think our psychology is not good enough if there's no actual understanding of what we are doing in the market. Now, that context area is where we can then start going into the lower time frame to look for an entry. Again, the entry, I need you to understand. A lot of people think that the entry is a direct correlation to the outcome of the trade. So it's the last thing you do, it's the last thing you look at before you click buy or sell. That is your entry. So a lot of people think that that last thing that you do before you click buy or sell is the most important factor in if it's going to be a winner or a losing trade. That's not true. There's not a direct correlation if the entry is good. And that's a flawed understanding. It's not about the entry. It's about everything that happens before it. So the bias, is the narrative good? Are there, for example, one-sided arguments, how we turn a subjective into objective? The reason why that's quite important to understand, I always mention that the hard work is done on the higher time frame. The entry, get creative with it. Do whatever you want. So you can use even simple candlesticks to just look to get involved. Just simply look to buy. You can use fair value gaps. You can also use fair value areas, but it doesn't really matter. It's just about understanding that you need to get involved right there once your context area has been met. So for example, right here, we have already determined, if this is for example an entry, which was my entry actually for this trade as well, then we have already determined through the context area how far we can retrace, because at that moment in time, there's not a whole lot of reason for retracement anymore. So we can simply place our stop loss below the recent PDAs that we have right there and then target a 1 to 2 RR. And that leads to foundation level number 5, because that is your risk management. Now, your risk management is absolutely crucial. Now, before we dive into that fully, into psychology and the risk management, let's track it back a little bit, because what we have just done, we have just established, or we have given an example of how you can take a concept, then turn it into those objective guidelines, for example. The reason why that's important is because then you have something to work with. So you actually know, for example, what you're waiting for in the market. And when you know that, you now have a trading plan that you can start executing on. Now, at first, your trading plan will not be great. So what usually happens with traders is they start trading and they start taking losses. Now, and when they start taking these losses, They think the trading plan is essentially broken. So it doesn't work. The concept is wrong all of a sudden. Even though it did resonate with them, they just throw it out of the window all of a sudden and they start finding the new best concept. That is important to understand because quite frankly, most of YouTube and most of the people watching YouTube as well are just there for the next fancy concept. Now, because you're still watching this video, you're a little bit different. So you have a lot more hope in you. There's a lot more potential in you to make it in trading. So when you start losing these trades, your fight or flight starts getting activated. So either you start, running away essentially from that trading plan you had, you get scared a little bit, you start running away to the next best thing, or you start to fight it. And that's what we want to do. So we want to fight it. And how do we do that? Well, when you start trading, you want to start journaling your trades. And it's surprisingly interesting how many people do want to profit from trading or anything like that. They want to be successful in trading, but they don't even journal. Like the most basic things just simply do not happen. I'm not sure how you can expect a whole lot of success in trading when you think everything is going to be easy, where everything is going to be straightforward. Now, I do have to say, everything is quite straightforward. So we, for example, in MT, know exactly how you get from A to Z, where you get from little knowledge to scaling capital and payouts. The steps are quite straightforward, but the steps oftentimes are not even done. Or for example, before we move on, what I also can't quite grasp is why people need everything to be easy. So for example, why do you always need the concepts to be easy? Now, it's not everyone. For example, it might not be you. But why is it supposed to be easy? If it was easy, it probably wasn't even worth your while. So if it was easy, everyone by this time would now be profitable. It's not easy. The steps, I always like to say, are quite simple, are quite straightforward to a certain degree, but easy, no. And again, it's not meant to be easy. This is not meant to be easy to be successful in trading. For some reason, the trading community has created this perception that trading is going to be the way out for a lot of people, where they are in debt and they can click a few buttons and all of a sudden make a Lamborghini or a nice fancy watch. And doing that, whilst everything is super easy, it's essentially handed to them. I'm sorry if you need to hear this reality check, but that's simply not true. That's not going to work. If you want to succeed in anything, just like in trading, it's just a skill that you need to learn. So you need to invest time. You need to invest effort. You need to dedicate yourself to the craft. Now, if that doesn't appeal to you, then that's perfectly fine, but then trading is not for you. But then neither are a whole lot of other things out there in the world and in life. Because anything you want to get good at just simply requires a whole lot of dedication and time and effort. And getting good at anything is never really going to be easy. Anyway, your journal is going to have all your answers. So when you do take these trades and you start journaling, you don't necessarily need to ask me what you're doing wrong or what's happening or if your trade ID is valid. No, you should ask your journal. So your journal always has all the answers to your trading problems. To whether you have high probability trades, to whether you have low probability trades, your journal has the answers. And the way your journal has the answers is because when you start journaling, you will start noticing certain patterns. Hey, when I trade during 2 p.m. and 4 p.m. on Nasdaq, for example, that's when my trades are very likely to play out. So that makes it a high probability trade ID for me. Hey, if the higher time frame is aligned with my ID, that makes it higher probability. Start noticing these patterns. Noticing these patterns also is quite basic effort. Usually that's what it comes down to. A lot of people think that you need some expert insights. And of course, insights from me or from someone who's been there, who's done that, can help. Yes, for sure. But when you're human and you have a brain like you can also recognize these patterns yourself. Your brain is a very powerful pattern recognition tool, essentially. Your brain likes to see patterns in everything, likes to see reason in everything. So when you go through your journal and you put some effort into it, you start writing down what is happening, your brain will pick up on these patterns automatically. You just have to start doing it. That's usually the part that doesn't happen. You just have to start doing it. Then eventually you'll start noticing you'll get better. So for example, you'll start to transition from an unprofitable trader to a break-even trader. Now, from an unprofitable trader to a break-even trader, that happens usually quite fast when there's some level of basic effort invested into trading. From break even to profitable, that's where it gets a little bit more difficult. This is, for example, also where a trading frequency comes into play, but also psychology and risk management, which again, we're going to dive into in a second. Trading frequency is also important to understand. So at first, what happens usually is people start to learn about these concepts and they get excited. Whoa, these fair value gaps, these are these magical things. Every fair value gap will hold. And they start trading fair value gaps. And quite frankly, soon after they'll find it takes a little bit more than just knowing about fair value gaps than simply buying and selling every first fair value gap that they might see. It reminds me of something that I've seen in the past. I think it was Alex Hormozy who mentioned this, where people usually start off with uninformed optimism right there. So they think this fair value gap is going to take them to profits, endless profits. Now afterwards, once they do start buying these fair value gaps, selling these fair value gaps, you'll notice it doesn't really work. So you get into informed pessimism. So what happens with uninformed optimism right there? Usually the trade frequency is very high. You start buying and selling every first fair value gap that you see. Then once you get to informed pessimism right there, and you get into this valley of despair where you don't really know what you should be doing. And that's also usually where most people quit. But if you stick through it right there and you become informed optimism right there, that's where we can actually start achieving certain things. So what tends to happen is you go from a lot of trades to then informed pessimism to almost no trades, where you're waiting for high probability trades, but you're not actually too certain what high probability actually at its core is. So from one extreme, a lot of trades, a lot of losses, almost no trades, well, not a lot of losses, but also not a whole lot of winners right there. Then we need to find a balance. We need to see if we can get to a stage, okay, we know what high probability is right now. We can find a perfect balance between not too many trades, but also almost no trades. That is one of the first steps, what your journal is also going to help with. Because again, at the start, taking a whole lot of trades is not necessarily a bad thing, but you do need to understand that taking trades initially is not there to succeed. Well, yes, it is there to succeed in the long term, but the goal of taking trades initially is ideally just to simply gather some data, some actual live data that we can then dissect and see, hey, what is working and what isn't working. So you're essentially setting yourself up for success in the long run. Now, what a lot of people think, their expectation, what I also used to have, is the first account I bought was a 50K FTMO challenge. Now, I passed that challenge, don't get me wrong, but I went into that challenge with the mindset this is going to be easy, and this challenge is going to, my first challenge, is going to lead me to a whole lot of profit. No, that first challenge is actually there to allow you to see what is working and what isn't working. So usually it's better to go for a smaller account, use a little bit lower risk to get a better idea. What actually is my trading plan? What are the high probability trades? What are the low probability trades? And once you have a better understanding of that, then you start scaling slowly. So finding that balance in that trade frequency is also really where your journal is going to come in. Now, once you have a better understanding of what your edge actually is, you know what you're looking for in the market, you know what high probability is, what low probability is. That's when it is going to come down more to psychology and risk management. Now, the reason why I like to tie these in together is because risk management and psychology go hand in hand. So if you mess up in your psychology, usually that leads to you messing up in your risk management as well. If you mess up in your risk management, usually that is because you messed up in your psychology. I need you to understand how I like to believe. Again, this is a theory. I don't know if it's necessarily true. I like to think like this, because it helps me, it helps students quite clearly reach a profitable stage. Again, everyone can learn these concepts. Everyone can learn the best concepts out there. Yet still 90%, 80% of the traders lose money over the long term. So why is that the case? If anyone can learn the same concepts that profitable traders have been using as well, then clearly it's not necessarily concepts. It's not as simple as a copy, so Control C, Control V, and copy a winning trader strategy to your strategy and then start applying it. It's not that straightforward. So then what is it? Well, I think it really comes down to, then eventually it comes down to psychology. And the reason why I think that is when we think of large hedge funds, when we think of institutions, these have very good traders or even bots that are trading their capital essentially. So they don't struggle with psychology. Now, us retail traders, we do struggle with psychology. So liquidity on a retail level perspective comes down to psychology because it's clearly not the concepts. So what actually is happening? Why 90% of the traders are losing their money? Well, how many traders on the opposite side of your trade are currently taking a trade outside of the trading plan because they're getting impulsive, because they are revenge trading, because they are over trading. Think about that. Anytime you place a trade, there's someone on the other side that is messing up in their psychology. It's now revenge trading, doing something that they're not supposed to do. So messing up in their psychology. So for me, on a retail trader perspective, it really comes down to who can keep their psychology in check the longest and can stick to that edge that they have. And then from there, it's just scaling. Now, this is where we first of all really need to get to the basics. So first of all, your chart time. How much time are you spending looking at your chart? I need you to understand. When people think of full-time trading, they usually don't think of trading. They start associating it with full-time. So a usual full-time job is, for example, you go to an office from 9 till 5, you work, you put effort into it as well, and that's going to lead to better results. So there's somewhat of a direct correlation. The more you do it, the better results you are going to get. Full-time trading is the opposite. It's not the usual world where the more effort you put into it, the better results you're going to get. It's not the more you trade, the more you look at the chart, the better results you're going to get. So in trading, less is truly more. Now, of course, everyone knows less is more in trading, but few people actually believe it and completely understand it. You can know about things, but until you experience it for yourself, that's when you start actually believing it. And that all starts with your chart time. So for every step in your trading plan, you can likely use alerts. You can set an alert. For example, if we need to disrespect Payouts based on running a rejection high, I can set an alert right there above that high. And then that triggers that we trade back into my context area where I'm now going to look for an entry. If your entry is a fair value gap, then you can also place an alert for that. Then what you're doing right there is you're constantly minimizing your chart time. There's this direct correlation that the more chart time you have, the more likely you are going to do something that you shouldn't be doing. So the analogy I like to use is a trader that is looking at their chart a whole lot and for very long is quite desperate for profits, right? It's the same as someone who's walking in the desert for a very long time and is then starting to get desperate for water. You start to hallucinate. So your mind starts playing tricks on you and thinking that there is water in the distance. That's the same in trading. The longer you stare at the chart, the more your mind is going to hallucinate and force IDs. Again, I just mentioned as well before, your mind is a pattern recognition machine and probably the best that we know of. So when you start staring at the chart and you're actively looking to trade, your mind starts recognizing these patterns and starts thinking that there is something there, then deviating from your original trading plan. So limiting chart time is always number one priority. The same if, for example, there's an NFP release. I know how fun it can be for an exciting news release to happen in the market and you see that crazy volatility coming up and down. It's very interesting to see, but it's not needed. So if you're not going to trade an NFP, which again, I wouldn't advise to trade it directly. If you're not going to trade it, then why look at the chart? Why be bothered about what's happening? Because it's just consuming energy. Now, it's arguably the same as, for example, watching some YouTube drama over some YouTubers or something that's happening with drama involved, and you're just watching it for pure entertainment. Again, it might be entertainment, it can very well be. But if you're not going to do anything with the information, if you're just there for the gossip, just for the drama, then it's just wasting space inside your mind. That space could have been used for some useful information that you're actually going to do something with. And not only that, because it gives you a psychological advantage, an edge, a psychological edge over another trader. Again, if I like to believe that from a retail dynamic perspective, we see, okay, psychology is the determining factor if someone is profitable or not. Of course, edge is also very important, but who can keep their psychology in check the longest, that's usually the person that is going to outcompete the other person that's going to mess up in their psychology earlier. Then by someone else watching, for example, NFP or watching the chart a whole lot when it's not needed to watch the chart, they're more likely to force trade IDs earlier, so deviate from the trading plan. So now that is your liquidity for the person who is not looking at the chart that often and who is sticking to their trading plan. Now, once you understand limiting your chart time is absolutely crucial, then I think this is also a realization that you don't necessarily need to quit your job to start trading, or you need to quit doing something to start trading. Quite frankly, trading actively doesn't consume, on a retail perspective, doesn't consume a whole lot of time. Now, when you do start trading, you have your chart time somewhat under control. you will notice there are certain emotions that are going to come up in your trading and whilst trading. What is important to understand is that, for example, recording yourself like this whilst you are trading, or journaling in a Notion or just in a textbook and writing down what you are feeling at that moment in time is really helpful. So for example, when I sit here and I look to live trade and I do commentary on my own live trading right here, it's very unlikely that I'm going to tell myself and towards the camera, I'm going to say, right now, I'm going to look to overtrade right here. Right now, I'm going to look to revenge trade. No, it feels like someone is watching. So you hold yourself accountable. That makes sense. And then the important part is to become conscious of the fact. So become aware of the fact of what you are feeling. So people used to tell me a lot, you need to turn off your emotions. So like a robot, you need to trade like a robot. It's so unrealistic. You are human. You are going to feel emotions. When someone punches you, you are going to get angry. And of course, it varies from person to person. A monk, if you punch a monk, it's unlikely that he's going to get very, very angry in comparison to a random person on the street. They might get more angry. So the amount of control you have over your emotions, that's the important part. It's realizing that you do have emotions, but that you can control them. So you can decide if you want to act on the emotions or not. So the way you do that is by first realizing that the emotion is there. So for example, when I place a trade, sometimes I'm also uncertain. I'm like, ooh, this is a bit tricky. There's arguments against me, arguments for me. I'm not too sure what to do right here. But my trading plan says objectively, I need to take the trade. Okay, so then I become aware of what I'm feeling at that moment in time. And when you become aware of what you're feeling, you can then consciously act on, okay, what is the right thing to do right here? I am feeling like this. This is influencing my thinking. And then I can make, based on that, the right decision. That is already 50% of the work done right there. Just knowing what you are feeling at that moment in time. Now, slowly, over time, you'll start getting a lot better at this. And slowly over time, this thinking even becomes a habit. So you automatically already know, hey, I'm feeling like this, I should be doing this, where you're not even worried about emotions anymore. You're not worried about your psychology anymore. Then on top of that, what I also want to mention is ideally at first, you want to just stick to one trade a day. There's really rarely a need for more trades than one trade a day. Now, especially when you're just starting out, you haven't shown any signs of profitability just yet. And if you haven't shown any signs of profitability just yet, you can't convince me that you can find even one high probability trade in a day, let alone 2 or 3. Maybe first focus on one high probability trade a week. So if you do take that one trade in a day, what is important afterwards to prevent yourself from at first overtrading, revenge trading, getting impulsive, whatever the outcome is of that trade ID, simply take a step back. Don't look at the chart anymore. So whether it's a loss, whether it's a break even, whether it's a winner, you are affected by any of those outcomes. You don't think the same anymore as you used to when you got fresh into the chart. Because with a winner, your euphoric state affects your judgment, your objective judgment of your trading plan and your trading ID. For example, a trade might not fit the rules perfectly, but you think, oh, but my previous trade was a winner. I feel confident. I feel like I can take on the world. Let me place this trade as well, to then potentially blowing your profit. The same if it's, for example, break even and the dust start running through your take profit, you are now going to act impulsively. I can't stress you how many times in the past I've had it that my trade hit break even and it still started running or started showing signs that it was running towards my take profit. And then I was like, oh, this is still running to my take profit. I need to get involved right now. Only for it to come back and instead of a break even now turn into a stop loss and a full loss. And the reason why it's important is because your break even is there for a reason, right? Your break even is there to protect you. So usually what happens, your break even, your stop loss is going to be at the place where we turn from high probability to low probability. So when your break even gets met, we're not in high probability conditions anymore. So you don't want to look for another trade ID. The same for when your stop loss gets met. Just journal it, move on, take a little bit time away from the charts right there. Maybe find a hobby, play some guitar, play some piano, and do something else with that time. And then come back tomorrow or later in the evening, for example, during the day with a fresh mind. Now, before we dive into risk management, I also want to mention that psychology, again, is not the holy grail. So what I mean by that is at first people might find their edge and they think, okay, well, this is working. This is clearly working. There's evidence that this is working. Past challenges with this. Then they really start to focus and narrow down on their psychology and they somewhat forget their edge right there. So it becomes this dusty old book that they never look back at to see if they're still doing good. For example, the most efficient way to get somewhere, which is sometimes not ideal, but it's likely to go straight, in a straight line. So from here to my door, I want to walk in a straight line. Now, when you want to walk in a straight line over a long period of time, you might want to look back a couple of times to see if you're still walking in a straight line, or if you're deviating from your line. And the reason why that's important is because that's what usually happens, where over time you start deviating a little bit from your trading plan. You're not too sure what you used to do. You're not too sure if you're still doing the right thing. So you constantly need to evaluate. You constantly need to see and look at your journal. Hey, am I still doing the right thing? Is my edge right here still in place? Can I improve something? And if you're constantly evaluating that, and then on top you have good psychology, you're constantly adapting with the market. So people used to also tell me a lot, the market is always changing, and experienced traders say this quite often. The market's always changing and you always need to adapt. What I thought at first that meant is that every single month I need to have a complete new trading plan. It scared me. It scared me because I thought I wasn't ready for that. I thought I needed a complete new concept, new strategy every single month, every single year. That's not true. So the market is constantly changing and you do need to adapt, yes. But the market has these slight changes, very subtle changes that you almost don't notice. So if you're constantly, for example, monthly or weekly, you're constantly evaluating your trades, then you are constantly adapting already. So you're changing with the market, even though it might be very subtle. And then combine that with good psychology and, well, you are going to be perfectly fine. But only if you do understand that risk management is also very important. Risk management, quite frankly, allows us to be traders in the first place. So we can somewhat mathematically also understand what our win rate is, what our RR is, and based on that, what the outcome should be over a large sample size of trades. This is also where risk management comes in, and consistent risk management. Risk management for me is also, of course, how much you risk. But at some point in your trading, you're going to get to a stage where you really need to determine and evaluate to see if a certain trade is worth taking. That for me is also risk management. So if it's worth it to put capital on that specific trade ID, or is it worth it more to wait for a potentially better opportunity? So let me give you an example. When you trade, and no matter what you trade, eventually you are going to get an ID of what high probability is and what low probability is. So for example, some people mention every single day is a trading day. And although this might be true, within every single day being a trading day, there is going to be different probabilities. So if you don't know that, then you simply don't have the data or the experience just yet to know that. So for example, for myself right here, if we take a look at gold, I know it's higher probability for my plan right here to continue higher right there. So that is also what I want to wait for. That is what I want to put my risk towards, my capital towards. So if we do get a bearish fair value gap right there, for example, that I can see the opportunity, but just because you can spot an opportunity does not mean you should take the opportunity. So for example, is that opportunity right there worth it for me? I know it's a lower probability. I can put 0.5% risk on it right there, but is it worth it? Would I rather wait right there for a higher probability opportunity than put my risk towards it on that high probability trade? That's important. And that's eventually when you get to a more advanced stage. Because this also leads a bit back to the trading frequency, what we talked about. Trading frequency, a lot of people think, okay, I want to increase my trading frequency. So for example, I might go into the 1 minute or well, do something else to increase my trade frequency. So for example, go from 3 to 4 trades a month to now 10 trades a month. You need to understand, increasing your trading frequency does not mean that you're automatically going to be more profitable. Usually what happens is that your losses scale with your trade frequency. So the more trades you're going to take, the more losses you're also going to take. So increasing your trade frequency oftentimes actually means increasing losses, increasing headache, increasing hits in your psychology. Let me ask you a question. Sorry for the change of camera angle. My camera was empty, so I have to charge it in a specific plug. Anyway, I was saying, would you rather be the trader that takes 10 trades a month, but the outcome is 2 RR, or would you be a more conservative trader where you take 1 trade a month, but that trade is very likely to be a winner and also results in 2 RR. That is usually where less is more comes into play, where a higher trade frequency does not result automatically in more RR or more winners. Now, then at last, what is important to understand is your risk management. So for example, when you go into funding accounts or you want to get to a payout, risk management is absolutely key. So for example, if you do go into drawdown or lowering your risk, if you're in profit, you can potentially increase your risk a little bit. But if all you are constantly doing is just 4% risk, the full daily drawdown, to then just try to pass the challenge and try to get a payout again, then I'm not sure we're even talking about trading anymore. Now, these are things that really matter in trading. And these are the things, if you understand them, these are really going to get you to the next level to, for example, getting a funded account, to, for example, getting a payout as well. So if I have disappointed you that I have not uploaded a fancy concept today within the new episode and the last episode of the Pips to Payout series, then again, I guess I'm sorry to disappoint you, but I'm not sorry for giving you this video, because this video is very, very important to understand, and it's what's actually going to get you to the next level as well. All right, perfect. Thank you.